21 million LLCs. According to the IRS, there are 21 million active LLCs in the United States till today. And the most common question that most LLC owners are ultimately asking themselves is, how do I pay myself properly through an LLC? Is it through a normal bank transfer? Am I issuing myself a W-2 payroll? Am I issuing myself a 1099? Do I have to write myself potentially even a check? How exactly do I need to be paying myself correctly through this LLC? That is exactly what this video is going to go into depth about, making sure you are paying yourself the correct way so you're staying compliant with the IRS and you're not causing any red flags. My name is Karrington. I'm a 23-year-old enrolled agent. Welcome back to my channel. First, let's start with how your LLC is ultimately being taxed. Now, this kind of goes back to when you originally first set up your LLC. If you were just a normal individual, you didn't necessarily have any business partners, you didn't elect to be a corporation of any sort, you more than likely set up what is the most common LLC till today, which is the single member LLC. According to the IRS, single member LLCs are seen as disregarded entities. Now, what exactly does that mean? That means when you ask the IRS, they see you as the individual and the LLC as one person, meaning any income that you receive in your LLC's bank account, if you're a single member LLC, the IRS is pretty much saying you've already paid yourself that money. You can go ahead and transfer that money out of the business account over to your personal account and not necessarily have to worry about any tax regulations, tax hits, or anything like that. Because again, the IRS sees both you as the individual and the LLC as one individual party. There is no separation. There is no separate business filing that you're having to worry about. Typically, when you are a single member LLC, you're going to be filing what is referred to as a Schedule C on your normal 1040 tax return. A single member LLC is going to be the simplest LLC that you can ultimately have. The only other caveat that I want to mention is when you're a single member LLC, you are absolutely subject to self-employment tax. And a quick little recap as to what self-employment tax is. Self-employment tax is Social Security and Medicare taxes. Now, when you're subject to self-employment tax, you're not only paying the employee portion of it, which you're used to if you have a W-2 job. Typically, you're paying about 7.15% of self-employment taxes whenever you have a W-2 job. In this case, if you have a single member LLC, you are paying 15.3% in self-employment tax. Now, why is that? Because technically you are considered the employee and the employer when you have your own business. So you must pay both the employee and the employer share of the self-employment tax. The beautiful thing is, one last caveat with a single member LLC, is that currently you actually get a deduction for it on your personal return, where they will actually go ahead and create an adjustment to the point where you're only paying half of your self-employment tax. You get an adjustment for 50% of the self-employment tax that you're ultimately paying. So again, you're pretty much only subject to paying about half of that self-employment tax, which is balancing out to roughly around 7.15%. Okay, so let's take a couple of steps back. So let's just assume that instead of you forming a single member LLC, you had a business plan that involved a partner. So you wanted to actually form a multi-member LLC. The name in and of itself is a little bit self-explanatory, but multi-member LLCs require at least more than one individual partner. Has to be two or more. If you have a multi-member LLC, the biggest thing that's going to be changing for you is now you are required to file a 1065 partnership business tax return. Now, this is completely separate from your normal 1040 personal tax return. Now, whenever you're filing this partnership tax return, again, there's two different ways that you can pay yourself through this partnership. The first one being a more streamlined process, in my opinion, and that's what's referred to as a guaranteed payment. The second option is doing distributions. Now, allow me to explain the two. Let's just assume with your partner, you have a business that grossed revenue of $100,000, for instance. That $100,000 is great. Now you and your partner are deciding, hey, I want to be reimbursed for the services that I provided this partnership. I want to be paid for my services. This payment is considered a guaranteed payment. Regardless of even if the partnership didn't necessarily make any money, this guaranteed payment is going to be something that's going through because it is payment for the services that you are providing this partnership to make sure it is potentially profitable, making money, everything is operating correctly. So these guaranteed payments, let's just go back to the company that made $100,000, let's just say. You and your partner decide that you want to issue yourselves $20,000 as a guaranteed payment. That's $40,000 in total. That $40,000 is actually going to lower the partnership's taxable income. So now the partnership's taxable income drops to only $60,000. Now, that being said, the $20,000 that you and your partner both pay yourselves is going to be taxable to you. It's done by a simple bank transfer. You don't need any additional documentation or anything like that. It's going to be done by a simple bank transfer, and it's just going to be documented as a guaranteed payment. Don't get it twisted. You still have to pay the tax on that $20,000, and you also will need to pay the tax on that $60,000 that is left on or in the business bank account. Now, with that $60,000, it's more than likely going to be split between you and your partner, assuming a 50-50 split. That $60,000 is going to be split 30-30, and it's going to hit your return in the form of a K-1. A K-1 is essentially purely just a summary of what happened income and expense-wise on your business return. It is something that businesses issue individual tax returns or individual members of the partnership. Let's just put it that way. So that is the option number one. You can do a guaranteed payment. Option number two is you can do a simple distribution. Now, a distribution is essentially you just pulling money out of the business bank account willy-nilly whenever you ultimately want. It's not necessarily compensation for services or anything like that. It's really just you pulling money out of the partnership because you potentially need it at some point. And you have the ability to go ahead and distribute money or pull money out of the partnership as you please. Now, is this going to lower the partnership's taxable income when you take a distribution? No, that is the big difference between a guaranteed payment and a distribution. A guaranteed payment will lower the partnership's taxable income. A distribution will not. Now, apples to apples, right? Just stick with me here for 2 seconds. This $100,000 partnership return, you and your partner have it 50-50, right? So income-wise, it's allocated $50,000 to your partner, $50,000 to you as the individual. Regardless, if you make yourself a $20,000 guaranteed payment and that $20,000 is taxable to you on the personal side and the other $30,000 is taxable on the business side, you're still netting out with $50,000 worth of taxable income. The reason I made that point is because whether you're doing a guaranteed payment, whether you're doing a distribution, you're still going to have to pay tax on whatever income is left over in that partnership. Regardless, you're going to have to pay tax on whatever income is ultimately left within that partnership. So that's extremely important. If we made $100,000 after all expenses, guaranteed payment or not, distribution or not, we are still going to have to pay the tax on that $100,000, both obviously 50 and 50 between me and my said partner. That is how you're paying yourself out of a 1065 partnership return. Now, let's reverse it back really quickly. The other option that you have as an LLC is if you're getting tired of that self-employment tax. Like I said, it's 15.3% right off the top. Again, you do still get that deduction on the personal tax return and you get to deduct about half of it. So really, it's netting out to about 7.15%. But regardless, that is still a lot of tax that you're paying on top of your normal income tax on your personal return. So some people get sick of that, especially if obviously their single member LLC is generating over $40,000, $50,000, $60,000 in net income. We have to ultimately make a switch at that point. That is when it makes sense for you to switch over to an S corporation and make an S election. Now, how is this done? An S election needs to be done, and you need to file Form 2553. And I'll say it again, 2553. That is what is referred to as an S election. Once you have that form filed and you fax that over to the IRS, you can now have your LLC being taxed as an S corporation. An S corporation, kind of like a partnership, is a separate business return that is ultimately being filed. So, what is the biggest difference between how you're paying yourself through an S corp versus how you pay yourself through a partnership? With an S corporation, everything changes. Everything on the S corporation side is now no longer subject to self-employment tax, right? Any income that you're making through your S corporation is no longer subject to self-employment tax. So how must you pay yourself, or you're required to pay yourself through an S corporation through a W-2 wage, and more specifically, a reasonable salary for that W-2 wage. All right, let's put it in reverse one more time. Let's just say, instead of doing that single member LLC, or let's just say you did that single member LLC, but you're getting tired of the self-employment taxes that are associated with it. Like I said, it's 15.3%, typically right off the top. Obviously, don't get me wrong, you do get that deduction for about half of the self-employment taxes. So it's really netting out to about 7.15% that you're paying on top of your normal income taxes. Now, that can be a lot of tax that you're ultimately paying, especially if your single member LLC's income is starting to get up there. You're looking at $50,000, $60,000, $70,000 worth of income. It is definitely time to make a switch at that point to allow yourself to be more efficient and not have to pay so much in taxes. This is when making an S selection or filing as an S corporation makes the most sense. When you switch over to an S election, you need to file Form 2553, and I'll say it again, Form 2553. That is the form that allows you to change how your LLC is ultimately being taxed. Once you file that form and elect that you want to be taxed as an S corporation, what changes? Guess what? All of your self-employment tax goes away. But again, and you're probably telling me, Karrington, this sounds a little bit too good to be true. What do you mean all my self-employment tax goes away? I don't have to pay that 15.3%. There's a caveat. What makes up that 15.3%, if you guys remember, again, that is Social Security and Medicare taxes. Social Security and Medicare taxes are also what you pay into when you're paying payroll taxes. A requirement for the S corporation is that you must issue yourself a reasonable W-2 wage. And what is attached to those W-2 wages? Payroll taxes. So the IRS, they're pretty smart. They got it figured out. But I'm going to explain how this transition is ultimately going to help you. So let's go back to our $100,000 business, for example, right? If we were a single member LLC, that $100,000 is going to be subject to, again, that 15.3% that I'm having to pay on top of my income taxes. With me switching over to an S corporation, like I said, there's going to be two different ways you're going to have the ability to pay yourself through an S corporation, one of them being required. The required way you need to pay yourself as an S corporation is issuing a reasonable salary as a W-2 wage. So with that $100,000 business, let's just say that I run a tax and accounting firm, and a reasonable wage for me, who is the owner of the firm, is, let's just say, $70,000. Let's just say that $70,000, but my business net income is $100,000, right? So I'm going to pay myself $70,000 of that. So instead of the full $100,000, if I were a single member LLC being subject to self-employment tax, the only portion that's technically subject to self-employment tax, but in this case, it's going to be payroll taxes because I'm an S corporation and I'm issuing myself a W-2 wage. The only portion of that $100K that's going to be subject to those payroll taxes is that $70,000. So that $30,000 isn't going to be subject to self-employment tax, isn't going to be subject to payroll taxes. That margin is going to be the tax savings with switching over from a single member LLC to an S corporation. Now, when you issue yourself that W-2, you are going to have to pay the payroll taxes associated with it. That W-2 is going to be something that you're going to have to file under your personal tax return. Like I said, $70,000 is going to pop up as an expense under the S-Corp, and then it's going to pop right back up on your personal return as income. The $30,000 that is left over, and here's the real kicker, that is not going to be subject, like I said, to any self-employment tax, any payroll taxes. That $30,000 is just going to be shown on your K1, and it's going to flow over to your personal return, and it's going to be taxable as ordinary income. That is a huge, huge, huge benefit. Now, the second way that you have the ability to pay yourself out of an S corporation is doing distributions. So let's go back to our $100,000 S corporation or business, for example, and let's just say our top end revenue is $100,000. I know that I'm paying myself $70,000, right? I'm getting a bi-weekly paycheck, but let's just say something comes up in my personal life and I need more money out of the business return. What am I doing? Again, we're doing a simple bank transfer from the business account over to our personal account. That money that is sent, it can be $20,000, $30,000, it can be $50,000, is seen as a distribution. There's no additional tax that I need to pay on that money or anything like that. I'm obviously still going to be subject to income taxes if I made that money in this current year. What do I mean by that? Our $100,000 business, let's just say from last year, right? We made the $100,000 this year, but let's just say from last year, we still had $20,000 left over in the business bank account. So for this current year, technically, my $100,000 that I made plus the $20,000 that I had left over from last year that I already paid the taxes on, I have about 120 in my business bank account. If I pull $50,000 out as a business distribution, right? An S corporation distribution, I can pull $50,000 out and not necessarily have to worry about paying tax on 20 of it because I've already paid tax on 20. The other 30, I will need to pay tax on it. Again, that is going to happen when the K1 ultimately flows through to my personal tax return. So hopefully you guys are sticking with me here, and this is kind of starting to click just a little bit. You definitely need to have an understanding of how the business income shifts over to obviously your personal income and understanding flow through entities and the whole 9 yards there. Now, we just went over single member LLCs. We went over multi-member LLCs. We even went over LLCs electing to be taxed as an S corporation. We still have one other way that an LLC can be taxed and how to pay yourself, and that is an LLC electing to be taxed as a C corporation. Now, this is definitely a very big move. Let me just say that now. A C corporation is not a flow-through entity. It is completely different from our partnership return. It's completely different from our S corporation return. Like I said, both of those are flow-through entities. Anything that's done on the business side, a K1 is going to be issued, and the K1 is going to be reported onto your personal return. A C corporation does not have a K1. A C corporation is completely separate from you as the individual. What exactly do I mean by that? A C corporation has its own business return, but it also has its own entity level taxation. Meaning, if we go back to our $100,000 example, if we make $100,000 in that C corporation and we have no expenses on that $100,000, it's not creating a K1 that's going to flow through to our personal return, and that $100,000 is going to be taxable on our personal return. No. A C corporation will pay tax on that $100,000 at the corporation level. Our corporation tax rate is 21%. So you would have to pay 21% of that $100,000 or $21,000 worth of federal taxes for that C corporation. Now, there's two different ways that you can go about paying yourself through a C corp. The first one being the most common way, paying yourself a W-2 wage, right? You can go ahead and issue a W-2 from the C corp. It's going to lower the C corp's taxable income, so it doesn't have to pay tax on the wage that it's issuing to you as the owner. And then from there, obviously that W-2 is going to be taxable on your personal tax return. Do know that that W-2 is still going to be subject to payroll taxes, right? We're not getting out of those payroll taxes. And that W-2, like I said, is going to be reported under your personal return, but you aren't necessarily going to worry about any self-employment tax or anything like that, as mentioned prior. Now, the second option that you have, paying yourself out of your C corporation, is going ahead and issuing a dividend. That is you transferring money out of the C corporation's business account directly into your personal account. There was no payroll that was issued or anything like that. It's just a direct transfer. Now, previously, when we were talking about this was seen as a potential distribution, right? Or maybe a guaranteed payment. With a C corporation, this is seen as a dividend. What is the biggest caveat between the two? It's not an expense to the C corporation when you do that. When you pull money out of the C corporation's bank account and put it into your own personal account and it's not considered a payroll, right? It's not an expense to the C corp. This is where we get the famously coined term double taxation. Because if we go back to our same $100,000 business, if I were to pull $20,000 out of it and just transfer it directly into my personal account, that C corporation still has to pay tax on $100,000, right? So it still has to pay $21,000 worth of taxes because, again, the C corporation's federal tax rate is 21%. So we'll have to pay 21% of the $100,000, even though I took out 20, it would still have to pay tax on that $100,000. And on top of, I have to pay tax on the $20,000 that I pulled out of the business bank account because it is a dividend to me. I still have to pay tax on those $20,000 on my personal tax return. That is the double taxation. That is something that we absolutely do not want to do because, again, that is the least efficient way for you to ultimately be taxed. You're being taxed at 21% in the C corporation. You're being taxed on money that you pulled out of the C corporation, and you're being taxed personally as well. So that's what's creating the double taxation. That's going to be a big no-no. If you want to pay yourself through your C corporation, you typically are going to have to issue yourself a W-2 wage out of that C corp. That is probably going to be the most efficient way to go about it. Plus, issuing a W-2, it gives you access to making contributions to 401ks or other different retirement accounts. So today in this video, you learned the 4 different ways an LLC can ultimately be taxed and the correct way to pay yourself out of the different tax treatments. If you learned anything new or you got any value from this video, please drop a like and subscribe. I make videos like this every day, just teaching the basics about tax knowledge. Again, my name is Karrington. I'm a 23-year-old enrolled agent, and bye for now.